All
Good
set.
morning. I'm Mary Quay, the Associate Commissioner for Market Regulation and Professional Licensing here at the MIA. And with me from the MIA, I have Jamie Sexton, Associate Commissioner for External Affairs and Policy Initiatives, Amelia Stedman from our External Affairs Office, Patty Dorn, Associate Commissioner for Consumer Education and Advocacy, Karen Lamb, the Chief of Health Insurance and Managed Care, and Jason Little, our Chief Enforcement Officer, and Craig I from our Communications Unit. And I would like to welcome Senator Bidel and Delegate Wu. I believe that's who I see. And I'm going to go over a few procedures we would like to follow today. When it is time for public comments, we will hear from participants who access the Zoom webinar platform. You can communicate with us through the chat function or raise your hand. The MIA will continue to keep the record open until December 3rd, 2025 for additional written comments. And we did receive written comments that we've already posted to our website. The video of today's meeting, as well as all written testimony submitted, will be posted on the MIA's website. To ensure excellent sound quality throughout the meeting, we ask that you please stay on mute unless you are speaking. Also, anytime before speaking, if you could restate your name and organization clearly, that would be a great help. The purpose of this meeting is to discuss level funded plans, what they are, concerns about the sales practices that may be used, and whether there should be regulation over those sales practices. Level funded plans are a type of self-funded arrangement that have become popular with small employers in recent years and have been a topic of discussion among regulators. As many of you know, Maryland has a statute, Section 15129 of the insurance article, that addresses some of the issues around the sale of stop-loss insurance to small groups. And that statute addresses specific concerns, such as the removal of individuals from the coverage afforded to the group health plan, and it also requires disclosure before entering into the contract with the small group. And that disclosure form is in COMAR 311043. The MIA asked David Smith of the National Association of Benefits and Insurance Professionals to give a presentation on this topic. David, welcome, and thank you for being willing to present to us today. Please introduce yourself and we can start your presentation.
Thank you, Mary, and thanks to everyone in attendance and to folks from the MIA staff. My name is David Smith. I run a benefits agency in North Carolina and am part of a bigger organization called Brown & Brown Insurance. I'm also involved with the National Association of Benefit Insurance Professionals, which is the preeminent organization that works with agents, brokers, consultants, and really ultimately represents the interests of our clients who are the ones purchasing and using many of the insurance products and other benefit products that are available in the market. I'm going to share my slides if that's okay at this time, and then I'll get started. Hopefully you can see those. Okay. So, I think most of this presentation is similar to something we shared with the NAIC a few months ago, but really ultimately reflects a lot of what we are experiencing in the market as it relates to level funded plans and some of the things that are working and not working. But really, ultimately, this is to prompt both the knowledge level within the regulatory community, but also ultimately to help improve the overall condition for the sake of the people who are buying these benefits, because that's where we think one of the big gaps has been. Level funded is, I like to say, just another way of saying a self-funded plan arrangement for employers to purchase health benefits for their employees. I always hesitate to call it health insurance because obviously it is not health insurance. It is a self-funded plan and has things that look very much like a health insurance policy, but instead uses stop loss and other risk mitigation approaches to that. As a result of them being self-funded, they are exempt from certain ACA mandates. So risk underwriting is allowed in small employers, and then other state benefit mandates that might have been adopted in Maryland, for example, would not apply to these plans because of ERISA preemption as it relates to self-funded plans. Ultimately, we've seen the number of level funded plan products in the market increase dramatically as the ACA went into effect and eliminated the ability for ultimately carriers to rate small groups based on risk. So the biggest reason why this has been favorable to many employers has been that this allowed the markets to go out and effectively cherry pick or select the low risk groups and then offer them a coverage or a plan cost that was lower than what the cost would be for that same benefit plan on the fully insured market. This process has been obviously very, very favorable to the healthiest groups who probably saw the biggest jump in their cost when the ACA and its elimination of rating bands kicked in. And what's happened as a result is there's been ongoing progression of healthier groups, lower risk groups being selected and selected against the entire market, often leaving now the fully insured market in a very negative place. It also has given them options to other ways to access both networks and to take advantage of the ERISA preemptions to give them other financing options for how they will offer health benefits to their employees. So it's been this kind of very attractive thing to, I would say, some employers, but I would say 10 years in, and particularly over the last 5 years, we're really starting to see the impact of this selection process impacting the remaining group market, uh, probably to the detriment of the bad risk or the unhealthier of the small groups that are out there in those markets. This has been very attractive to carriers and service providers. For carriers, it's been great because it's given them greater flexibility in terms of how they price, underwrite, and actually write business because they've been able to go out and offer more competitive rates rather than to just rely exclusively on plan design or other kind of variants. They also are avoiding compliance with state benefit mandates and then things like the medical loss ratio rules that exist under the ACA. Um, for a lot of the stop loss carriers, particularly those who are good at underwriting, this has been a very effective strategy to cherry pick and take those healthiest groups out of the small group market and move them to a different funding arrangement. It also allows them to escape some of the regulatory oversight that some states have adopted in terms of rate setting and proving their overall rating model versus their cost. And I'll say that the last piece is equally important. Um, a lot of motivation has been as people have gone and adopted level funded plans, PBM revenue, which has become a very, very large revenue source for many of the kind of vertically integrated carriers, has been another aspect of revenue that they're making on top of any premiums or other costs that they're holding on behalf of the clients. I'll also mention, I think this has been very attractive for service providers like TPAs and other smaller networks, and even some provider owned networks to be able to reach the small group market because they can do that through a level funded arrangement instead of going through the regulatory difficulty sometimes of being approved as an insurance carrier in a particular state. So you see all the reasons why this has been attractive to each of these different markets. I think some of the biggest concerns that we've faced in the market operate around these areas. The first of which is a true lack of understanding on the part of many of the employers who are purchasing these plans from thinking that they're buying something other than a fully insured product. The amount that they pay each month looks like a premium, but in reality is a combination of typically 4 or 5 elements, stop loss insurance, administration, the amount that they're setting aside for claims, the cost for any other outside services that are related to it. But most do not understand that what they're getting as it relates to stop loss on things like eligibility rules or on the application of subrogation for self-funded plans and how that's different than how it operates in the fully insured market are different because of the fact that they are self-funded. And so these are areas that we think that we consistently run into employers who don't really understand that they're in a self-funded arrangement. And sometimes that you really see that play out as it relates to contract terms or even on the denial of claims because someone was not actually an eligible employee and had been left on the plan. In addition, you see the things like incurred versus paid. Some of the compliance obligations that we've definitely run into and kind of continue to have a concern about is that for those employers who have less than 20 COBRA FTEs, so let's say you have a 10 life group that has purchased a level funded plan in nearly every state in the country. That group does not have COBRA rights because they are under 20 FTEs. And they do not have state continuation rights because state continuation does not apply to level funded plans. And so you will find groups in that under 20 kind of bucket who will find themselves without any COBRA coverage. They're not aware of their 5,500 reporting requirements as funded welfare plans. That's an important distinction. And ordinarily, under the 5,500 rules, there's an exemption for employers under 100 covered employees who have unfunded welfare plans. And under the code and under the operation of the 5,500 instructions, where the claims funds are actually being held by a third party, like a carrier or a third party administrator, then in that situation, they are no longer considered unfunded welfare plans, but are now considered funded welfare plans and therefore have to file 5,500s. Many of them are unaware of their ACA reporting requirements under the 1094B and 1095B requirements, which fall under Code Section 6055. How to handle excess claims funds. So when they have a surplus of claims funds, how do they do that? How do they do that money? How do they handle it? Do they have to distribute it to their former employees, et cetera? And I'm just walking through each of these and kind of giving you the relevance of each. 105H is a Internal Revenue Code section that currently applies to only self-funded plans that prohibits discrimination in favor of highly compensated employees in terms of their benefit eligibility, contribution, or the actual benefits themselves. We've run into a number of situations where employers were having had adopted, I would call favorable contribution requirements. In some limited situations, even management carve-outs that are using level funded plans that are fairly explicit violations of the 105H rules. Mental health parity compliance is an ongoing concern. Because they are self-funded, we have found consistently most administrators will not prove compliance with the mental health parity requirements and the testing because they say we're self-funded and we're just an administrator. We don't have any control over it. But in reality, these small employers do not. Some state rules, like New York Pool, still requires reporting for self-funded plans, and we found kind of inconsistent compliance by many of the carriers or the actual claims administrators for these plans in handling the New York Pool reporting requirements, and that becomes an issue. And of course, because you write a presentation, apparently I said the same thing twice. We'll ignore the second 105H. How about that? Some of the emerging risks that we're starting to see. Fortunately, United this year, earlier this month, actually in October, announced that they were going to end their Medicare estimation process for employers with less than 20 employees. But we're still seeing that happen with some other level funded plans. What that is where a employee who is over the age of 65, they're on a group that has less than 20 employees, that because of the way that the Medicare secondary payer rules work, now in that situation, Medicare is primary. And the Medicare estimation process, as it's been carried out, would basically say, regardless of whether or not you've signed up for Medicare, you still have to have Medicare, and we're only going to pay what we should have paid as a secondary payer. I have a situation in Tennessee that left somebody with a bill of over $30,000. Had another one in Texas for a friend of mine that left him with a bill of over $60,000. So how Medicare estimation is being applied to these groups when the actual person who's 65 or older either is unaware of their need to get it or having to face IRMA excess charges has decided to stay on the group health plan. There are other federal regulatory requirements related to RxDC, gag clause, PCORI, air ambulance rules, No Surprises Act, all of which are becoming bigger and bigger deals for these groups because they're unaware of the fact that they need to do them. We also know that many of these plans are not taking into account some state requirements that are not otherwise exempted by ERISA, like the Massachusetts minimum credible coverage requirements, the Hawaii Prepaid Act requirements, and also PBM reporting issues that have popped up in states like Arkansas, Indiana, and that are some of which are under some form of litigation, but are still something that most level funded plans are unaware of the fact that they need to do. And then I think broadly, these employers are unaware of the fact that they have fiduciary reporting obligations. I'll take a pause and see if anybody has any questions before I continue on. Okay. So the real issue that a lot of people have is like, how are these things being structured? So typically in a monthly amount that very, very much, I talked to a group yesterday, and they happen to be on a level funded plan. They have over 90 employees, but what they are looking at to compare their cost is truly a number that looks like a premium number. But inside of that is really the sum of these elements. The first of which is the cost of stop loss insurance. Many states require, particularly small employers, to have specific stop loss insurance, meaning that the first X thousand dollars of claims is on the responsibility of the employer, but anything above that amount belongs to the stop loss carrier. So we had the example I was with yesterday. They had again 90 employees. The first $50,000 was on them, and then they were paying for a stop loss insurance premium that covered any claimant who exceeded $50,000. Some states do not have specific stop loss mandates for small group, and therefore these groups only have aggregate stop loss, which is limiting what they spend on all their employees in terms of their paid claims. If they're specific, then below the specific stop loss deductible, but otherwise the aggregate is covering all the claims are being paid by the employer out of their claims fund. The second element of that cost is the cost of administration. So paying for a medical claims administration, paying for pharmacy benefit management if they are not using spread pricing, all of those will be included in that element. Often this is where you might also see commissions or other compensation to an agent, broker, consultant who helped put this policy into place. And then the third element is the claims reserve, the amount that's being paid each month into the claims administrator to hold to pay for claims that are expected to be incurred during the contract period. And often we get the question of, well, how's that money typically distributed? And so what I did was I took a client of ours and just showed that over this particular group, 30 employees, over the course of 12 months, their average monthly premium, or the average monthly amount they paid for their level funded plan, was $20,577. Over the course of the 12 months, they had put about $108,000, almost $109,000 into a claims reserve to pay for all of their claims. They paid a little over $96,500 for their stop loss insurance, and then $41,000 for administration. So it's not, you think about comparing that to the small group markets and the expectation they spend at least 85 cents in the large group market, 80 cents in the small group. I'm sorry, 85 cents in the large group market, 80 cents in the small group market towards the cost of coverage. Well, obviously that those proportions are not the same as in this particular in the way that most level funded plans are set up. So we had a number of questions that have been raised to us, like what's the typical stop loss attachment points? We're seeing them typically for small group range between $10,000 and $50,000 in the states that mandate it. There are some states, for example, Texas does not require that that small groups have specific stop loss, so they're only doing aggregate. And the attachment points for aggregate stop loss truly vary widely based on the underwriting, the exposure cost, and ultimately what the group looks like and the benefits look like. One of the areas that I think would be good for addressing within state regulation would be the way that's lifetime or annual limits. Now, it's important to recognize that these plans are still compliant as it relates to ACA mandates. Okay. So there is no annual or lifetime limit on benefits for the employee, or the participant, but often there's no limit on how much can be reimbursed on specific stop loss. And that's pretty much universal in my experience. I will tell you that many level funded plans do have a $1 million cap on their aggregate reimbursement. And that may be a holdover from past practices where the way that most aggregate stop loss works in the traditional self-funded markets is the likelihood of $1 million reimbursement on aggregate when you've got a specific stop loss attached to it is incredibly rare. And so having a very, very large aggregate reimbursement would be unusual. But when you're in a small group, and let's say you have 5 or 10 lives in a level funded plan, purchased, for example, in Maryland, and you had somebody on a very expensive medication, or you had someone had a very expensive course of treatment related to cancer or heart condition or something like that, where you have no specific stop loss, you could wind up in a place where that $1 million cap on aggregate reimbursement could actually create an exposure point for that employer that they're not aware of. So that would be one area that we think definite action should be taken. Are there typically monthly limits on how much the employer would have to pay within their specific and aggregate stop loss? Typically, yes. We see almost every one of these policies including what we would call monthly accommodation provisions in level funded plans. And that way it avoids some of the variance. And I'd say part of the reason why this hasn't been a big deal and we haven't run into a lot of these issues is because if you're a carrier or an administrator, not providing monthly accommodation either by the terms of the contract or just in the operation of the plan would create, in our minds, regulatory issues that would probably cause it to see public light, and therefore no one wants to have that happen. Are there situations where a claim might not be covered because it lasted beyond a certain point in time? Absolutely. And a lot of that has to go with how stop loss contract terms are written and what kind of run out protection there is, either through terminal liability or some other kind of post in a contract protection. Again, this is a place where the market reality is that most people are making sure that employers are not purchasing inadequate contracts. But I can tell you in the last 3 months, I have an organization I've done some work with in the past who had one of their employees have one of their clients purchase a 12-12 level funded plan, not in Maryland, obviously, and had a terminal liability option for them, but the terminal liability option language limited to them going to another level funded plan. And then the group ultimately decided, because they'd had a particularly bad year, that their only option was to go back to the fully insured market. And now we're left with the exposure claims beyond that were left unpaid at the end of the 12 months of their stop loss contract. So I do think having minimum stop loss contract terms would be helpful for the market and would be important for protecting the interest of consumers. Typically, kind of carrying on that tail coverage, it does vary wildly, but a lot of it has to do with how excess claims fund calculations are done and what's left to pay for any of those outstanding claims. I will tell you, operationally, we see that a large percentage, over 99% of claims, are being completed and resolved within 6 months on traditional network plans. But when you have people who are using non-network based plans like reference based, you were seeing those claims take much longer, and so completion factors are not the same over 6 months as they might be over other contract terms. So then that leads to the next logical question, which is: are there instances where people could be, where employers could be left owing money after the end of a plan year? And yes, there are situations where that happens. And again, we see many of the larger carriers be very diligent about their contract terms, doing at least 1224 or 1227. In one situation, they will only sell the 1260. And I've admired their rationale for that because they've shown the statistic about why that's relevant. And so I do think having adequate terms is all about making sure that the employer who has purchased that plan, thinking it is just like a fully insured plan, then finds out in the aftermath that they have some obligation to pay some claims that were not covered under their stop loss contract, and that creates problems. Some of the gaps in protections that we're seeing that are popping up a lot are actively at work employees. So someone who has now maybe exhausted their Family Medical Leave Act or state leave protection. Someone who's a dependent but not an eligible dependent. I cannot, unfortunately, share with you the shock in the number of times I've found in large employers doing audits of dependent eligibility where someone was listing two spouses, usually because their former spouse had some provision in their divorce agreement that their now former spouse would continue to cover them, and so they've left them on the plan and listed them as a spouse, and then later get remarried. Obviously, those situations happen, but we've seen plenty of examples lately where that failure to follow actively at work rules has created a situation where a stop loss carrier has refused to provide coverage for someone with the excess losses. Excluded benefits for things like work-related accidents or personal injuries that may be subject to subrogation are all things that most employers are not aware of the fact that apply to them and how they need to work. And then how to apply any retained rebates or the application of retained rebates by the administrator to an aggregate accommodation. So, for example, and I'll use one that I saw, I'm going to say 6 months ago, where if you looked at a traditional aggregate tracking spreadsheet that I would use, my calculation was that the employer had exceeded, and therefore aggregate should be taking care of those costs above a certain point. However, the administrator in that situation was applying rebates on RX that they had retained, and then applied that to the aggregate accommodation, so it reduced what the aggregate accommodation would be. Again, most of these are not very well explained. How they will apply and actually get used in later operation are not very well understood by those who are buying it. And unfortunately, there's some assumption that the people who are buying it are experienced buyers, even experienced producers. And again, I've said this term 3 or 4 times, but having taught level funded courses to other agents, brokers, and consultants in our business over the last 5 years, the number of times I've been told the following words: this is just like a fully insured plan. Why do I have to worry about this? it reflects a simple lack of understanding that these are self-funded arrangements. Typically, is there a contractual commitment that the amounts will not change over the course of the year? Yes. There may be the occasional provision that says if your membership changes by more than 10%, we reserve the right to re-rate. That exists in most small group markets today. But I would say that very rarely do we see changes mid-year on those monthly amounts. The one issue on these contracts that has been a kind of consistent concern has been when there's been an early termination and how that would impact the coverage for stop loss and other protections inside of the agreement, including the run out claims that may come up after a contract's termed early. And oftentimes the decisions for an early termination of a level funded plan is because of some business need, financial realities of the business, they're going out of business, or that they've been acquired. And the acquisition issue is something that is often being missed, and then things are popping up in the aftermath. Are these plans typically comprehensive plans? Yes. And I've rarely see a plan that isn't. There is some variability about which state they will use for benchmark plans. And so you see that, and then you've seen some variability for benefits outside of the EHB or benchmark plans for coverage of other benefits like chiropractic or limitations on covering things like GLP-1s. So each of those kind of variabilities happen. How are these groups being rated? Because there is underwriting, we see really about 4 different ways that that's happening. Many are still using individual medical questionnaires, which is sending now typically an online form to each of the employees who works there, asking them a series of medical questions to gauge and to do group level underwriting. We also see increasing use of something called artificial intelligence underwriting. Gradient AI is one of the big players in that space that go out and they rate, and they project cost for a particular group based on information that's available in terms of medical and RX claims for each of the people listed on the census. The group I talked to yesterday, again, 90 employees, Gradient was able to identify about 81 of those 90 employees on a review of the available data to do an underwriting for that group. Some are using prescription drug database, the public database that reflects what prescription drugs everyone has. And then we're seeing some review of the Consolidated Appropriations Act required carriers and service providers to provide de-identified data sets to fully insured groups. However, there's been some lack of consistent compliance with that by a number of different carriers in different markets that has been a struggle to actually get that information to allow employers to make good decisions. Are the premium levels comparable to ACA small group markets? I would tell you that in a normal market, they're running between 5 and 15% lower. The greatest gift they have is they can decline to quote because it is level funded. I would also tell you we're starting to see that gap widen. So if they're a level funded plan, the more that groups are able to be selected into a risk-based underwriting methodology, those healthier groups are getting out of the small group market, which as a result leaves the overall average of groups left in the small group fully insured market to be less healthy. And so therefore it's creating this widening gap between what level funded is and what traditional fully insured markets are, simply because if you're in a healthy group, you're going to pay more than a healthy group. What's the typical amount of churn? We do see a decent amount of change and jumping around, particularly in competitive markets. And I think the increasing appearance of other non-carriers like TPAs popping into the market is giving more competitive options. Probably one of the most common questions that I see when I have gotten into this, even originally, was the promise of a return of some of their claims funds. I would tell you that my observation is the number of groups who actually get a claims refund has become increasingly low, typically less than 20% of employers. And it's usually because of how the expense ratios are happening between how much is being set aside in claims, admin cost, and stop loss. So this is the example I always use of, if to the right is a traditional self-funded plan, you can see the vast majority of the money's being set aside is going into claims. The percentage of going into consulting fees or commissions is typically the same. Admin is usually a little more expensive. Terminal liability, aggregate stop loss, specific stop loss premiums are all much more expensive on level funded than they are in traditional self-funded markets. And then these next few questions are usually are about larger employers. What we're seeing, do we see a lot of level funded in the 50 plus market? And I would say, yeah, we do see a decent amount of it. It's, now those employers are trying to choose between fully insured, a level funded or balanced funded approach, or a true absolute traditional employer stop loss self-funded approach. And again, why are oftentimes these employers doing self-funded versus a large group fully insured policy? And it's literally to give them more variability in terms of how they're doing their risk assumptions. Some are afraid of doing all the risk and the ways that traditional self-funded plans work versus the way that level funded works in terms of minimum premiums and the like. So, we are seeing employers in that small end of the market looking more at level funded as an alternative or a middle step between fully insured and traditional self-funded. I think some are also doing it because they're kind of dipping a toe into the self-funded world, as I say, because they want to kind of learn that experience. They avoid state benefit mandates, and they have a better opportunity to preserve and do set aside reserving for their claims. Sorry, Delegate, I'll finish my piece and come back if that's all right. Unless you want me to stop, I can also stop. I'll defer. Mary, would you like me to stop? Or you want me to keep going? I'm sorry.
Let's keep going and address questions
Okay.
at the end.
I'll do
Thank
that.
you.
Yes, ma'am. Yep. If allowed to buy a small group insurance policy with same plan design, why would they do that? I mean, literally, it comes down to how the risk is done. One of the things I will tell you, as I've gotten older in this business and manage a number of people in it, and have probably more personal exposure to people on the commercial side, I'd say if we have a great gap within the agent broker consultant community, on the employee benefit side versus our commercial comrades, I would tell you it all comes down to the lack of really understanding risk management and how risk plays a role in employee benefits, and the real gap in those principles, and also really understanding an employer's risk tolerance. I find that understanding a particular employer or owner or manager's risk tolerance as it relates to benefits is the most important aspect of the discussion, because then it tells you what their options are in terms of how they will best finance their health benefits, whether that's through a group insurance policy, a level funded approach, or a traditional self-funded approach. If we had some basic recommendations, we would say that there ought to be more common contract definitions within stop loss policies, particularly for level funded plans, both stop loss and how it's defined, what the requirements are, contract terms, and the like. We believe strongly that there ought to be better disclosure requirements for level funded plans. I've shared with MIA the forms that we use for our clients to make sure they're aware of the fact that they're buying a level funded plan, which is a type of self-funded plan, and all the pieces that go with it, mainly so that we're helping educate them, make them aware of these issues. And then I think applying compensation transparency rules to all level funded service contracts would really help everybody, the employer, the agent, broker, consultant who's helping them make that decision, be aware of all the elements so that they're making the best possible decision. And I would say even to the next level of very clear application of disclosure requirements about all the data related to that plan. Also, as I knew I had that slide, I just had lost track. But I think giving that detailed data requirement will let that group really know what's going on. Again, I try to use examples of my real life in this. Yesterday, one of the things that this particular group was facing with their renewal was that they had an employee who had had a pretty serious heart condition, open heart bypass surgery about 12 or 14 months ago. And so all the group was getting told was that you have somebody with a heart condition, but for a little bit of social engineering and due diligence on our part, it would look like that would be an emerging or an ongoing issue, when in reality this is something that happened 12 to 14 months ago and would not be a cost impact on them in the future. And so I think application and availability of all this data as a requirement would be really, really good. I'll close with this, and this came from one of my carrier partners, and it's a communication that they provided with their small group renewals this year. And in our state, a lot of our small groups, small fully insured groups, are seeing rate increases in the 12 to 15% range. It has never been that high since the ACA went into effect, in part because North Carolina, until about 14 months ago, restricted the sale of level funded plans to groups who were 20 or more employees. As a result, the rest of the small group market was remaining really relatively stable. Now going from 20 to 12 with some push to go down to 5, just the concern of what it does to the remaining aspects of the market. And this statement, I thought, said it all. And I won't read it, but you can kind of see what one carrier is saying to their groups and to their agents about why their fully insured small group client agents or pricing is going up. And it's because what I mentioned at the beginning, when you cherry pick the healthy groups out of the small group market, what that leaves is often not healthy groups. And as a result, the overall average cost of those rates goes up. So with that, I will stop sharing and we'll answer any questions or do what I can to do my best. Thank you, Mary.
Thank you. That was very informative, and we appreciate your taking the time to talk with us. I see Delegate Hill is in the attendees, so I want to welcome her as well. And Delegate Wu, you had a question?
Yeah, thank you very much. And I have two questions. Number one, I see in one page you talk about the admin cost is around 40K, and then I look at the total cost is around 40% admin, or less, right? Is that number reasonable, or why is so expensive?
So in that situation, the 40K that was for administration was about 16% of the total cost.
Okay.
And that is, sorry, I always have a handy dandy calculator with me because I can't do that math as fast as I used to be able to. And I would tell you that if I looked at the average cost of administration, the average cost of stop loss, as that one slide showed, I tend to see it be typically 50 to 75% more as part of the expense of the cost than in traditional fully insured markets or even in traditional self-funded markets. And so where the carrier administrator can make sure that they're handling that distribution of percentages of what they put into claims reserves, cost of admin, cost of stop loss, you're seeing that float around to the point that less money is going into claims reserves, and therefore that's creating a problem. That does feel expensive, and I would agree with you. atypical compared to even traditional self-funded markets or traditional small group fully insured markets.
Thank you. A second question is about, because the ACA pools goes a little smaller based on what you said, right? Is
Yep.
that possible? We got a huge, for example, state employee, right? Or school system that got so many employees. If we put them in the ACA, will that stabilize that pool of, like insure, and then we provide, like, for example, some compensation, make sure it's still price compatible, stabilize the market from the state level.
I do think more lives is always good for market stabilization. I will tell you, Doug, that one of the things that I've run into is that idea would be good from a stabilization perspective, but I will tell you the biggest opponents to it would be state employees or even some of these school system employees, because they feel like they're having to carry the load. I will tell you, in my state, in North Carolina, we allow local governments to participate in our state employee health plan. And what we have found is the ones that are having bad years want to get into the state health plan, and the ones that feel like they could do better outside of it can't. And so the legislature in our state has actually blocked them from leaving once they come in. It's kind of a one-way door, and that's creating some consternation. I would tell you that if you really want to help your small group markets remain stable, and again, under the current regulatory environment in Washington, I'm not sure how easy that is done, but a 1332 waiver to really address and put in place reinsurance pools and to limit liability for excess claims would probably be the most stable approach. Virginia has just put in place one that I think would work well, which is saying to the carriers in the small group market, your liability for claims below some threshold, let's say $75,000, are yours. They typically have their own stop loss for claims that exceed, in my experience, somewhere around $250,000 or $300,000. And so you do some kind of split responsibility between 75 and 250. What you're really trying to do is level out the impact of those claims that fall into that range. And unfortunately, if I look at the large data sets that we look at on behalf of our clients, I mean, I'm a weirdo because I do both self-funded and I run a business and I do a lot of this risk analysis. I like data. I've seen the instances of cases above 50,000 jump almost 600% in the last 3 years. And a lot of that has to do with cost of medications, the fact that when someone goes to the hospital, they go and they stay, and increasingly the cost of outpatient procedures in hospital and facilities getting inpatient rates for it. So
Thank you. Thank you.
thank you.
And Delegate, we would be happy to answer that on a more state-specific level and some of the things that our actuaries have done with reinsurance in the individual market and how that works.
Thank you, Mr. Clay.
So
Okay.
question.
We have a question about claims data, and we do have a state law on that. I'd have to check the details of it. I don't remember it off the top of my head, but we can look at that and get back to you. But we do have something about providing claims data.
Yeah, and I do think providing de-identified detailed claims would be very helpful for employers, because then they understand the timing and everything else. It also, unfortunately, I would tell you that health insurance and health benefit markets are advantaged the more the consumers and agents, brokers, consultants understand exactly what's going on. When people get rate increases without real explanation or data behind it, it undermines trust and confidence in the market. And so, unfortunately, I think there's been a lot of smoke and mirrors over the years on it. And states like Maryland have adopted laws about it. We've seen South Carolina, Texas, other states do the same. We would actually advocate for a very comprehensive disclosure and actually just the enforcement of the CAA's requirements that talk about this. Somebody had their hand up. Mary, you're on mute.
Okay, are there other questions? I saw a hand up earlier. I don't see it now.
I see.
Okay,
Thank you.
well, thank you, David. We really appreciate this. This has
Yes,
been
ma'am.
informative. We will be posting this on our website. We will have comments open until December 5th. And that has been put in the chat. Those can come to me at mary.quay@maryland.gov. And thank you, everyone, for taking the time to listen to this today. And we're really happy to see the number of people who tuned in and paid attention. And we're happy to follow up with anyone who has additional questions or wants to submit comments. So thank you, David, and thank you
Thank
for
you, Square.
everyone who participated.
Thank you.
you.